Hello, this is Mark from tradingform.com and welcome to this video on how to invest profitably in the Nasdaq Composite and S&P 500 using a relative strength strategy. In this video, I'm going to have a look at these two markets and explain why I have chosen them. Then I'm going to have a look at what I mean by relative strength strategy. And finally, I'm going to have a look at this strategy and I'm going to show the historical results. So I have on the chart at the moment the two indices. In green and red there is the Nasdaq Composite, and in blue and grey is the S&P 500. Now you can see just by looking at this chart that the two markets have responded to the same type of situations. They've gone up and down in the same types of time period. However, what I find interesting and why I have chosen these markets is how they have reacted. We can see the much more exuberant Nasdaq Composite here in the dot-com boom and bust of 2000s. We've got here the financial crisis, crash 2008, 2009, and subsequent recovery. Now it is the way that the two markets have reacted that I'm most interested in, and that is why I have chosen them. I wanted to get one market, in this case the Nasdaq, that's going to take the most possible, have the strongest possible moves when things are looking good and things are moving very favorably. And then I want to have a relatively more defensive market, in this case the S&P 500, when things are not going quite as well. So what do I mean by a relative strength strategy? Well, in this case, very simple. As a general principle, it's a good idea to invest when things are going well and to get out or to sell when things are going not so well. But however, it is difficult, very often it is difficult to identify when something's going well and when it is going badly. If we can use relative strength, we can find out how similar types of markets are performing relative to each other. So in this case, I'm using relative strength to identify the strongest of two markets. And once I have identified this strongest market, I'm going to buy it. When things have changed and the other market is performing the strongest, I'm going to sell the original market and I'm going to buy the second market. Now the strategy that I'm discussing in this video today is a long only strategy. And this is how I have analysed the strategy. This is actually the latest version of the trade-informed backtest model, and it has been set up to analyse the relative strength of two markets. You can see here I've got the Nasdaq as market A and the S&P as market B. Now I've used this spreadsheet to firstly identify, there's lots of different ways you can do this, but I'm using the spreadsheet to identify strength and weakness for each market, and then I'm using it to analyse the results of the trading strategy. Now if you're interested in this spreadsheet or indeed would like to have a look at what other trade-informed Excel backtest models are available, there is a link on the screen and you can click on that link and see what is available. There is also a link in the information below. So let's have a look. We've got here the results. I haven't actually explained what the strategy is. Now, like a lot of these videos, I want to try and show you a relatively simple strategy. There's a couple of reasons why I tend to use relatively simple strategies. Firstly, it's because identifying investment and trading strategies is a very personal thing and everybody does it slightly differently. The second reason is the more complications you add to any investment or trading strategy, the more potential pitfalls you have in identifying as to whether this strategy is liable to continue to be profitable in the future. So it's a relatively simple strategy. I'm using one of my favorite measurements, and just to click back here onto the strategy for a moment, I'm using the linear regression line. Now the linear regression line, I should explain the linear regression line of the ratio between the markets. So when market A is performing relatively stronger, the ratio will increase, and so the slope of the linear regression will also increase. And once this goes above zero in this strategy, I'm going to invest in market A. If market B subsequently strengthens relative to market A, the line will start to point downwards, and once the line is pointing downwards, I will be investing in market B. There is an accompanying article. If you're confused by any of this, there is an accompanying article with the link down below, so you can click on that and get more information. So I've identified a simple mechanism to show me which market is performing stronger. And these are results that I have got. Now we can see here we have got the strategy in its basic form here, and I've compared some of these metrics to the underlying markets. A key one that most people will be looking at straight away is right here at the bottom, compound annual growth rate. Now this is obviously key to any long-term investment strategy. How much money are we investing, assuming we are reinvesting any profits back into the strategy? And we can see that in this basic form, the strategy is performing slightly worse, similarly but slightly worse than the S&P 500, and significantly lower than the Nasdaq. So what is the point of this strategy? Well, the point of this strategy, as far as I'm concerned, is the line above here, and this is the maximum drawdown. And I'm just going to scroll down the screen here. You can see I've got the two lines. I'm sure most of you are familiar with these markets. Got the Nasdaq here. Most of us like to think that, of course, we're only going to buy here and here. However, human nature and many studies have shown that, unfortunately, the majority of people are more inclined to buy here and to sell here. So drawdown is a huge problem for any investment strategy. This is by far the biggest drop here for the Nasdaq. This is the .com crash, 2001, 2 and into 3. And by this calculation, closing price to closing price, we've got an 83% drawdown. So we have from 1991 to 2016 a very nice annual growth. We also have an 83% decline in that. It would take a very strong-minded individual to hold throughout that entire period. Likewise for the S&P. In fact, we have two very large 50% or thereabouts falls in the market, the same .com early 2000s bust and the financial crisis here, two very large falls. So relative to this, the strategy that I'm proposing here in this video has got a 35% drawdown, which occurred at this point here, which is again is roughly coinciding with the financial crisis fall. However, because it's a trading strategy, there are things that we can do to even this out and see how it performs in different situations. Now, one of these is we can apply a stop loss. Now, the spreadsheet here has the facility to do a number of different things. One of these is to put a percentage-based stop loss. And we can see that as soon as I start doing that, although we see a decline in our net profit, annual growth, we are getting a smoother line upwards with a smaller decline. Put this up to 10%. And we can capture more of the profits and still keep a relatively minor maximum drawdown of just under 20%. We could also look at putting in a profit target. And you can see that by adjusting these parameters, we can change the strategy and potentially improve it, certainly in terms of our drawdown. So what I'm going to look at here is another thing that we can do once we've got the data and the information in a backtest environment like this. We can look at how strategy responds to increased amount of leverage. Now, because we have, historically speaking, a lower drawdown in this strategy, we can potentially look at increasing the leverage. So from relatively low, around 20% amount of drawdown, we can double the leverage, which means that for every 5% gain in the market, the capital invested in the strategy will increase by double that, so 10%. Potentially, we can increase this even further. Obviously, the risks increase exponentially with the more leverage that you use. So as far as I'm concerned, this is a strategy that does offer a advantage, particularly in terms of drawdown compared to both the Nasdaq and the S&P 500. Strategy keeps you on the right side of a strengthening market and offers you protection when things are not going quite as well. Now, if you'd like more information about investment and trading strategies, and also about the financial markets in general, please go to www.tradinformed.com.